Welcome to Technical Tuesdays. This is Fred Razak, Senior Trading Strategist here at CMTrading. And today we're going to be discussing overnight trades. Now, if you've ever been a trader and you've taken overnight trades, you know what I'm talking about. But if you don't, basically what it is a trade that you carry from day to day and you take the position overnight when the markets are actually closed. But before we delve into this, make sure to like and subscribe so that you could get future content just like this. Okay, so that's what overnight trading is. Now, most day traders or scalpers are in and out throughout the day, okay? They don't hold overnight trades. But if you're a swing trader or you're a quasi-investor trader, you're gonna look for overnight trades. Now, they carry with themselves some huge advantages and huge disadvantages. It's always a double-edged sword when it comes to trading. It's either amazing, okay, when you take leverage on one side, it's a double-edged sword, right? Because if it works towards you, it's great. But if it works against you, it's also not so great. So keep that in mind. When you're taking overnight trades, you are exposing yourself to risks. Now, there are certain markets that are trading 24/7. I'm not talking about those type of markets. I'm not talking about futures. I'm not talking about Forex symbols that are generally trading throughout the day and night. I'm specifically talking to index related stocks that have a open in the morning when the index actually opens, like the Dow Jones or the NASDAQ, and then towards the afternoon the index closes and then there's no trading in that particular stock. So it's mostly more relevant to stocks than to anything else. So let's delve into it and digest. Number one, it's probably one of the biggest opportunities to get big moves to happen. I'm going to tell you a story, okay, where it didn't work towards his favor, but imagine if it did. Now, my coach, my mentor, when I first started trading, his name is John Petak, and John was one of these type of guys that would have huge swings in the markets. And when he started trading, he took a particular position in a company called Alex Brown. Now, Alex Brown was a financial services company. It looked like as if it was really weak on a particular Friday, and he took a short position of 10,000 shares of this particular stock. He was already in the money, maybe a couple or few $1,000s already, and he looked like it was going to be a great trade for over the weekend, okay, which would have been an overnight trade. Now comes Monday morning, and on the front page of the Wall Street Journal, it says that Alex Brown was bought by another much larger financial institution. If I remember correctly, it was JP Morgan, but I could be incorrect. But that is what happened. And instead of the stock going down, the stock went up about 18 points. And as a result, his position went against him $180,000. Now, had it been in his favor, obviously that would have been great. Now, that happened to have been one of the best things that could have happened to John, because that was the catalyst that made him into the greatest trader, because he actually took the day off that day and within the next 2 months made that money back and then some. And it was only because of that adversity that he went through that he came out of it much stronger. So number one, it's big moves can happen when it's overnight, especially when there's news coming out, especially when there's earning reports, which usually happen after the market closes. So there are all these things that happen when the markets are closed. So number one, big moves can happen and do happen quite often. And if you're taking a trade for a few days, you're going to be exposed to this. This is going to be a natural progression because the markets will be closed and the markets will be open. And even if you're trading futures and Forex symbols that are going to be closed over the weekend, they'll have effects. For example, I'll give you an example where I made money is when the coronavirus hit. I took a position that previous Thursday where I shorted the Dow Jones minis. I saw things were coming in. It was about $32,280, something like that, 80 points. And on that Friday, it went in a little bit and I held a position over the weekend. And over that weekend was when the coronavirus actually went viral and the markets were actually responding to it. That following Monday, my position was up already 1,000 points. And that was just an easy position, easy opportunity to take advantage of. And, you know, these things do happen enough for them to be lucrative to take advantage of. Another thing to keep in mind is that you're charged a LIBRA rate. Now, a LIBRA rate is basically an interest rate by the banks that charge to maintain that position overnight. Now, if you're in a long position, you get charged, and if you're in a short position, you actually get credited that interest rate decision. So just be aware of it, that you are charged overnight. So if there are a few nights that you take it, just take that into consideration as part of the operating cost of trading that particular trade. The last one is that in order to trade overnight trades, you got to accept the unexpected. That's for sure, because anything can happen. Even if you put in stop losses, it could blow right through it, and you have to take that into consideration. So yes, is this riskier trading? Absolutely, but the benefits are also there as well. So this is something that you'll have to kind of manage for yourself and manage in your account in order for you to really be aware of the potential and also the demerits of it so that you can maximize on your trades. This is Fred Razak. I want to thank you for joining me today.